In the previous videos, we learned how options work. So now we are going to apply them for actual hedging strategies. So what we're going to do is motivated and summarized by this old saying here, which is everyone wants to buy options until they see what they cost. So the idea is that options on the first pass look very interesting because you limit the risk while keeping the upside potential. Okay, but as always, there are no free lunches. So if this looks good, it has to be expensive, and that's exactly the problem here. An option is expensive, and the typical prices can be significant. They can easily be up to 2 or 5% of the actual exposure amount that you're trying to hedge. So what firms tend to do is to come up with strategies that have a lower cost of hedging in exchange for being less than the perfect hedge. Okay, as usual, we will have to reach a compromise. So if we are paying less, we are also getting less hedging. Okay, so what we're going to do here is we're going to look at 3 typical hedging strategies that do exactly this. So that reduce the cost at the expense of working less than perfectly, right? Okay, so the first example is what is called a bull spread. Okay, so a bull spread is a portfolio of 2 options on the same underlying and with the same maturity, with this construction that you see here. So one option is going to be a long call option with a strike price K1, say K1, and so by the way, this is called a bull spread because so you said that something is bull when you benefit from a price increase, and you have here a long call, so you're going to benefit when the price goes up. So long call, and hence the name bull spread. So that's one. The second one is a short call with a strike K2, where we have this relation between these 2 strikes. So K1 is smaller than K2, right? So the idea is that we have to spend money to buy this first call, okay? But we're going to reduce our total cost by, at the same time, selling another option with a different strike. Okay, so we are going to partially finance the cost of the long call by selling the other call. By selling the other call with strike K2. Okay. And by the way, if we are assuming that K1 is smaller than K2, that has to imply that the call price with strike K1, so this price for this one here, has to be higher than the price of the one that we are selling. So we still have a positive cost, we still have to spend some money, we are just reducing the amount of money we have to spend, okay? So this is the profit from the strategy, including the premiums. So I am long a call K1, so what we have here is the possible payoffs depending on the final futures price, whether it is below the first strike, between the 2 strikes, or above the second strike. Right, so these are the payoffs. At home, please go through these expressions here and make sure you understand what's going on. So for example, the first line here is that I am long in the call. If the futures price is too low, I let the call expire, so I just lose the premium I already paid. If the futures price is above the strike, I exercise the call, so I get this payoff F, the final price of the underlying, which is the futures, minus the strike price, minus the premium that I already paid some time ago when I purchased the call. And the same thing, if the future is even higher, I still exercise the call and get the final payoff minus the premium. Okay. For the short call, it's the opposite of this. I'm on the other side of the contract, so I'm subject to the counterparty deciding to exercise. If the other side does not exercise, I just keep the premium. If he exercises, I keep the premium, but I also have to pay this payoff of the other guy. Okay. So now if I add the 2 things, the long and the short call, this is my total payoff. Okay, the sum of the previous 2 lines. Okay. So if you compare this payoff for the bull spread with a straight long call at K1, so with this first line, you will see that you will have a lower cost as you expected, right? So you are decreasing the cost by the C2 of the option you sold, right? But the drawback is that you have a smaller maximum payoff, right? So if you look at here at this extreme payoff, for example, if you had just a long call, this would be your total payoff. But now if you have the bull spread, instead of that, you have this expression here, which is less than what you have here, because you do not get this F, which might be very high. You are limited to this number here, K2. Okay. So let's see an example of hedging with the bull spread. So let's say that this is April 2013, and we have a refinery that will need to buy this amount, 1 million barrels of oil, in June 2013. Okay? And the manager is considering the following alternatives: doing nothing, not hedging; hedging with a linear contract, just a simple futures; or hedging with a straight long call, the one that we are saying it's expensive, but it's like the best alternative if we ignore the cost; or what we are now looking at, if we think this is too expensive, then we can go with this new strategy, which is a bull spread. Okay? And the current market prices on this date are these. Okay? And by the way, so these examples are a bit old in the sense that these are 2013 numbers. The oil prices nowadays are very different, but these were actually prices of options that I got from the exchange on this date. So I think this is good in the sense that it gives you an idea of the actual cost of working or using options, right? So on that date, if you looked at the WTI American options for June, these were the prices. A strike at 93 for a call, for a strike of 93, a call costed $177 per barrel, and with a strike of 96, the price was 0.62. Okay. So what we're going to do is we're going to compute the profit with a bull spread using these two options, and then what is the outcome? What is the effective cost, depending on the price of oil at the actual delivery date, right? Okay, so let's do this. This is the profit from the bull spread. So it's the same reasoning as we did before. We have a long 93 call, which we have to pay, right? We pay the premium here, 177, and then if the price goes above the strike of 93, we start to exercise and we start to make money. If it goes very high, we make a lot of money, right? By the way, there are some empty columns here. Please try to fill in the blanks here. What are the numbers at 93 and 96? Okay. For the short call, these are the payoffs, and then the bull spread is the sum of these two. Okay. So in a figure, it looks like this. This green line is the long 93 call, okay, the typical call, which I am buying, and then I'm reducing the cost of this by selling the 96 call. So my payoff looks like this. When I add the two lines, I get the red line, which is the bull spread. Okay. So again, this idea that I benefit from a price increase, but only up to a certain point. After this point here, I no longer profit anymore. Whereas if I had a call, I would benefit from the price increase all the way up until whatever high price it came up. It turned out to be. Okay. So what is the effective cost? So again, this example is for a refinery that is buying oil. So I'm worried about the price being too high. So I'm worried about the cost, right? So let's see what happens. I can be unhedged. So this figure here does not show the axis, but the axis labels, but this is the dollars per barrel, the final price, and this is my cost, right? So this is a high number here is bad because this is the cost. So if I'm unhedged, this is my cost. Okay, I'm worried about this range here where prices are very high. If I am hedged with the futures, I get this straight line here. I always get 93, which was the futures price at which I could start. I could go in, right, and buy this oil with these futures. Okay, so absolutely fixed no matter what. With options, if I just go with a long call, let's say I go with a 93 long call, then I get this line over here, right? Which gives me this very nice result, which is if the bad scenario happens, I am limited in how much I have to pay for the oil. So my risk is limited at this number here, right? At 94.77. And furthermore, I keep the optionality in the sense that if the price goes down, I am able to reduce my cost. Okay. The drawback of this is that there is this cost, right? When compared, for example, with the futures, I'm always paying this additional premium here, right? So if I think that this is too much of an insurance premium, I can go with a bull spread and get this red line here, which, as you can see, reduces the cost relative to the straight call, right? So it hedges over this range here. It still gives me this optionality part here in the sense that if the price goes down, I benefit from price decreases. But the downside of that, the drawback is that if the price goes very high, I stop being protected. So whereas with the call I was fully protected, with the futures I was fully protected, with this bull spread, I have this tail here where I stop having protection. So if the price goes up to 100, my cost goes up a lot as well. Okay. So that, I mean, it's this overall theme that we have everywhere. There are no free lunches. If you want a lower insurance cost, you get something less. And the something less is this tail here, where things are not as good as with the more expensive straight call. Okay, so second example, a bear spread is the opposite of this. So a bear spread is the same idea in the sense that we have two options. One is the one that you're long put. So you want a long put will benefit from price decreases, hence the name bear spread. You make money when the price goes down. But to reduce the cost of buying this put, you also sell a different put with the different strike prices with this relation that you see here. Okay, so again, the arguments are exactly the same as we did before. You can go through this table and see what are the payoffs of the two puts and the total payoff of the bear spread in this case. Exactly the same arguments. So this would be interesting for someone that is in the opposite side of the market. So now we are talking about an oil company that will produce barrels of oil. And so this is a company in the sense that it will dig the oil out and then it will sell the oil to the company of the previous example, to the refinery. So for these guys now the oil is the output. Okay, so for them the risk, the bad scenario is the opposite case now, is the price of oil going down, right? So they naturally will want to hedge in exactly the opposite direction, right? So again, the example looks at these same alternatives, not hedging with the futures, hedging with a straight long put, or hedging with a bear spread. So the results are exactly the same in quantitative terms, in the sense that you get the same type of relation, but now in the other direction. So this is the profit that the company gets from the bear spread. It makes money, and the red line is the bear spread. It makes money when the price goes down, which is the case that they are worried about, the price going down, but not fully. At some point, it just caps at this value here, right? So that means that the effective revenue that you get looks like this. If you are unhedged, you're fully exposed to the oil price. Okay, this is good, but this is bad. If you use the futures, then there is no risk anymore. You always get the same value here, 93. If you just use a straight put, you get this result here, in the sense that it protects you from very low prices and it lets you benefit from high prices, okay? But at this cost. If you think this difference here is too much, then you can instead do the bear spread, where it costs a little bit less. It still has a good upside potential. If the price goes up, you still benefit. But the drawback is that you're not fully hedged against very low prices. Okay, the third alternative is a collar. So now this is slightly different. So the idea now is the following. We're going to do a portfolio of two options on the same underlying with the same maturity with different strikes. And now we can do the following two alternatives. We call a long collar, long in the sense that we profit if the price goes up, to this combination of options. You're going to be long on a call with strike K2, and you're going to be short on a put option now with the strike K1. So this is a long collar, and the short collar is the opposite. You're long, not in the put, but in the you're in the short collar, you're long in the put. So you benefit, you make money if the price goes down, right? So now the idea is again to reduce the cost, but now you can do something even more extreme. So the goal is to finance the cost of the long option by selling the other option, the same as before. But now we can combine the options such that with the right strike prices, you can actually make this package cost zero. So it can have a zero upfront cost. Okay. So at home, try to do this. So try to draw the profile of this long collar, for example, assuming that the premiums on this call and the premium on this put is exactly the same. Okay, and you will find that the payoff of the long collar will look something like this: 45-degree line, then flat, then another 45-degree line. All right. So how does this compare? What is the payoffs that we get here? So comparing a long collar to a straight option, to a straight long call, the collar has the following. It has lower cost as we want it, okay, and can actually be very close to zero. It has higher potential losses for very low prices. So it's again going to lose that total hedge capacity that an option has now when the prices become very low. So what happens when you're using this to hedge the purchase of a commodity? What happens is the following: you have a K2, which is the maximum purchase price, but now you have also a minimum purchase price. So when you had just a simple straight call, if the price was very low, you would just walk away and not exercise the call, and that would cap your losses. But now, in addition to the call, you also have the put option that you sold that will kick in when prices are very low. So you will lose money when the prices are very low. And what that implies is that now you also will have a minimum purchase price, and that will be the K1 price. So the motivation for using these collars are the following. So typically, energy companies want to hedge for some length of time, for up to 2 or 3 years. But if you use just plain straight options for these maturities, it becomes very expensive, okay, as we discussed before. So the alternatives we saw before, like bull or bear spreads, they have a limited payoff if prices move a lot, if they go to the extreme. So recall that a bull or a bear spread would move, would have, like, for example, a bull spread will have a positive slope in middle ranges, but then it would be flat on both tails. Right? So these are better suited for short-term hedging strategies where you don't expect very large price changes in a short period of time. Okay? On the contrary, collars work in the opposite. So if a collar will have a payoff that will be moving in the tail, it will be flat in the middle, and then it will move in the other tail as well. So they are typically used in long-term hedging strategies where large price changes may happen. Okay. And so these are the advantages and disadvantages of the collars that we discussed. Okay, so let's see some examples. So let's see an example for hedging with a long collar. Okay, so now we are in the position of a refinery. Okay, for the refinery, the oil is the input, so they are worried about high prices. Okay, so they are going to use this quantity, 1 million barrels of oil per month. It's May, and they want to hedge for July next year. Okay, so we are in this longer term type of hedge. So let's say that the manager thinks that there is some potential for oil prices to decrease, which would be good, right? It's their input. So he wants to remain competitive in that case. So a linear hedge does not look attractive. So if you just use the futures, you're committed to the price no matter what, and that will again make the refinery lose competitiveness. On the other hand, 1 year is a long time, and he may be wrong, so he needs to cap the exposure to any abnormal events that may cause disruptions in the oil supply and prices to spike, right? So you have some view, you want to bet a little bit on it, but you don't want to leave the whole firm on the line, if you will. So if the prices go in the other direction, you want to be protected. So these are the alternatives we are considering. The ideal thing would be to hedge with a long call, right, which will give you the best possible outcome. If prices went up, you would be hedged. If prices went down, you would just let the call expire and benefit from the price decrease, which is what you are kind of hoping or expecting to happen. So the other alternative that is less expensive would be to hedge with a collar. Okay. So these are the market prices on May 2013, and these are actual prices. The futures is at 90 for next year. July next year is at 90.02. The options on that futures are these. So I picked a couple of options here. This is the futures price, or close to that, the closest one to the actual futures price. This is the call and the put, and then I picked a couple of options around this. So call a little bit above, and the put a little bit below. Okay. So this remark, just to note that this will not be exactly zero cost, because this price here is not exactly the same as this price here, because these are actual exchange prices. In a collar made over the counter, OTC, we could actually define the strikes to be exactly the necessary for this to have zero cost. So this is, again, just an approximation to what we could get over the counter, right? So using these two prices, let's compute the profit from a collar spread and then the effective cost for the refinery. Okay, so we are going to play with these two options here, the call at 94 and the put at 86, right? Okay, so the long collar is going to be this strategy here, long the 94 collar, and this will be the payoff depending on the futures price. And then to reduce the cost, we would short the 86 put, and this would give us this payoff. So that's the net result of the two things combined. This is the long collar, and this is, you may think of this flat band here somehow may remind you of the collar here around the neck, so maybe that's why this is called a collar, because of this flat band around the middle. Okay. All right. So what is the effective cost for the refinery? So once you consider all these alternatives, so it's very similar to the previous example we did. The unhedged position is this. This is bad because this is an input, and this is a high price for the input. I don't like this. This is good. If I hedge with the futures, I'm flat at 90. If I hedge with a straight long call, I get this green line here. Again, if the price goes down, I am happy because I can just walk away from the call. But and if the price goes up, I am protected, so I'm flat here. The downside is that I have to pay this big premium. So with a collar, I get something that is less expensive. So it's this red line here, which is less expensive than the green line. I am still protected if the price goes to the bad scenario. If the price is high, I am capped at this amount here, so I never lose too much money. I can still benefit a little bit from the price decrease over this range. But unfortunately, if the price decreases a lot, I am not able to benefit from it because I have this minimum price at which I will buy. So I never buy at less than this amount here. Okay. So again, one more time, and for the last time, there is no free lunch. Okay. And then this is an example of the opposite situation where we are again going to the other side of the market. Now this is an oil company that sells oil and it's worried exactly about the opposite scenario. So instead of using a long collar, it would use a short collar. Okay, so please go through this example. It's very similar to the previous example we did for the bear spread, but now with the short collar. Okay, so this would be the strategy that you would pick. This would be the total payoff. This is the short collar, the red line. Okay, and then when you consider this and the price you get from selling the oil, this is your total revenue. Okay, so this side here is good, this side here is bad, right? Again, you get this payoff when you hedge with the collar, which is less expensive than the straight option, but does not let you benefit from very high prices. Okay, it hedges the downside, but it does not let you benefit from the upside. Okay, and that's it. These are typical hedging strategies in the energy market with options. All right, see you in class.